In January 2009, the business world watched in stunned silence as one of India's most celebrated technology companies crumbled overnight in what would become known as India's Enron. Satyam Computer Services, a name that ironically means truth in Sanskrit, was built on a foundation of lies so elaborate and systematic that when Chairman Ramalinga Raju finally confessed, he revealed that his company had fabricated over $1 billion in cash that simply never existed. This wasn't just creative accounting or aggressive financial practices. This was corporate fraud on a scale that redefined what was possible in the world of white-collar crime. On January 7, 2009, Raju sent a letter to the company's board of directors and securities regulators that would shock the global business community. In his own words, he admitted to manipulating the company's books for years, inflating revenues by over $300 million annually, creating fictitious assets worth more than $1 billion, and lying to investors, employees, and regulators about virtually every aspect of the company's financial health. The confession letter read like a corporate suicide note, detailing how what began as a marginal gap between actual and reported figures had snowballed into a massive fraud that consumed everything in its path. The story of Satyam's rise and spectacular fall begins in the boom years of India's information technology revolution. Founded in 1987 by brothers Ramalinga Raju and Rama Raju in Hyderabad, Satyam rode the wave of global outsourcing that transformed India into the world's back office. The company grew from a small startup to India's fourth-largest IT services company, employing over 53,000 people and serving more than 600 clients across 66 countries. By 2008, Satyam was listed on the NASDAQ and the Bombay Stock Exchange, with a market capitalization exceeding $7 billion at its peak. The company's client roster read like a who's who of global business, including General Electric, General Motors, Nestle, Nike, and the World Bank. Satyam's success story was held up as proof of India's emergence as a global technology powerhouse, and Ramalinga Raju was celebrated as one of the country's most visionary entrepreneurs. He received numerous awards, including the Ernst & Young Entrepreneur of the Year award, and was frequently invited to speak at international business conferences about the future of global outsourcing. The company's headquarters in Hyderabad became a symbol of India's new economy, a gleaming testament to what was possible when traditional Indian business acumen met cutting-edge technology. But beneath the veneer of success, Raju was orchestrating one of the most sophisticated accounting frauds in corporate history. The manipulation began small, as these frauds often do, with minor adjustments to quarterly results to meet analyst expectations and maintain the company's stellar growth trajectory. However, what started as seemingly innocuous smoothing of earnings quickly escalated into a massive deception that required increasingly elaborate schemes to maintain. Raju and his co-conspirators, including his brother Rama Raju and the company's chief financial officer Vadlamani Srinivas, systematically inflated revenues by creating fake invoices for services that were never provided to clients who often had no knowledge of these fictional contracts. They fabricated bank statements showing cash deposits that never occurred, creating false confirmations from banks that appeared to verify the company's inflated cash holdings. The fraud was so comprehensive that it involved forging fixed deposit receipts, manipulating interest income calculations, and even creating entirely fictional debtor accounts to justify the inflated revenue figures. By the time Raju confessed, the company's books showed cash and bank balances of over $1 billion that simply did not exist anywhere except on paper and in computer systems programmed to display these false figures. The mechanisms Raju used to perpetuate this fraud revealed the sophisticated understanding of both technology and human psychology that made the deception possible for so long. Satyam's finance team, under the direction of CFO Vadlamani Srinivas, developed a parallel accounting system that could generate false financial statements while maintaining the appearance of proper internal controls and audit compliance. They exploited the complexity of international banking relationships by creating fake fixed deposit receipts and forged bank statements that were difficult for auditors to verify across multiple jurisdictions and banking systems. The fraud team manipulated the company's enterprise resource planning system to generate false invoices and accounts receivable entries that appeared legitimate to both internal reviewers and external auditors. They took advantage of the trust-based relationships with long-term clients by inflating the value of existing contracts and adding fictional additional services that were never questioned because the core legitimate work was being performed satisfactorily. Perhaps most cunningly, they structured the fraud to maintain consistent growth rates that appeared realistic and sustainable, avoiding the dramatic spikes that might have triggered deeper scrutiny from analysts or regulators. The sophistication extended to creating false email trails, backdating documents, and even establishing fake communication channels with banks to provide false confirmations to auditors who attempted to verify the company's cash positions independently. The human cost of maintaining this elaborate deception took an enormous psychological toll on Raju, who later described living in constant fear of discovery while being celebrated as one of India's most successful entrepreneurs. In his confession letter, he wrote about the sleepless nights and the mounting pressure of keeping the fraud alive, describing it as like riding a tiger, not knowing how to get off without being eaten. The fraud had grown so large that it required constant attention and increasingly risky maneuvers to maintain. Every quarterly earnings report became a high-stakes performance that required perfect coordination between multiple conspirators and flawless execution of document forgery and financial manipulation. Raju admitted that he had considered confessing multiple times over the years, but could never find a way to reveal the truth without destroying the lives of tens of thousands of innocent employees and causing massive losses to investors who had trusted the company. The weight of maintaining this double life while being held up as a role model for Indian entrepreneurship created what he described as unbearable psychological pressure. He spoke of the irony of receiving awards for business excellence while knowing that his entire success was built on lies, and the crushing guilt of misleading not just investors and regulators, but also the employees who had dedicated their careers to building what they believed was a legitimate and successful company. The unraveling began in December 2008, when Raju attempted to use Satyam to acquire two companies, Matus Properties and Matus Infrastructure, that were controlled by his family members. This proposed acquisition, worth over $1 billion, was ostensibly intended to diversify Satyam's business portfolio. But investors and analysts immediately recognized it as a suspicious related party transaction that made no strategic sense for a technology services company. The market reaction was swift and brutal, with Satyam's stock price plummeting over 50% in a single day, as investors fled what they correctly perceived as an attempt by Raju to use the public company as his personal piggy bank. Faced with massive investor outrage and pressure from the board of directors, Raju was forced to abandon the acquisition within hours of announcing it. But the damage was done. The failed acquisition attempt had focused intense scrutiny on Satyam's finances and governance practices at precisely the moment when the global financial crisis was making investors hypersensitive to any sign of corporate irregularities or questionable management decisions. Board members began asking detailed questions about the company's cash position and financial strategy that Raju could no longer deflect or answer, with vague assurances about the complexity of international business operations. As pressure mounted from investors, regulators, and board members demanding detailed explanations for the company's cash holdings and the rationale behind the failed acquisition, Raju found himself trapped in a web of lies that had become impossible to maintain. The Securities and Exchange Board of India launched an investigation into the proposed acquisition, while international investors demanded greater transparency about the company's financial position and strategic direction. Satyam's independent board members, who had been largely passive during the company's years of growth, suddenly found themselves facing intense scrutiny from investors and media questioning how they had failed to detect what was clearly a massive governance failure. The company's auditors, PricewaterhouseCoopers, came under pressure to provide more detailed verification of the company's reported cash balances and revenue figures, creating the very real possibility that a thorough forensic audit would expose the entire fraud. Trading in Satyam's stock became increasingly volatile as rumors circulated about the true nature of the company's financial position, and several major clients began reviewing their contracts, and considering alternative service providers. Faced with the impossibility of continuing the deception and the growing likelihood that a detailed investigation would expose everything anyway, Raju made the decision that would shock the business world and destroy his carefully constructed empire in a matter of hours. On the morning of January 7, 2009, Raju typed out a 5-page confession letter that would become one of the most infamous documents in corporate history. Addressed to the board of directors and copied to the Securities and Exchange Board of India and the stock exchanges where Satyam was listed, the letter laid out in devastating detail the full scope of the fraud he had perpetuated. He admitted that the company's reported cash and bank balances of 5 billion and 400 million rupees included over 5 billion rupees that did not exist, that accrued interest of 376 million rupees was completely fictitious, that understated liability accounts had hidden the true extent of the company's debts, and that overstated debtor positions of 490 million rupees were largely fictional. Most shockingly, he revealed that the company's revenues had been inflated by over 750 million rupees in the fiscal year ending March 2008 alone, representing approximately 25% of reported revenues, and that operating margins had been manipulated by over 300 million rupees to maintain the appearance of profitability and growth. The confession detailed how none of the board members were aware of the fraud, how the gap between actual and reported figures had started small but compounded exponentially over the years, and how he had been unable to find a way to bridge the gap between the fictitious cash balances and the reality of the company's financial position. In one of the most quoted passages, Raju wrote that what started as a marginal gap between actual operating profit and the one reflected in the books of accounts continued to grow over the years, and it has attained unmanageable proportions as the size of the company operations grew. The immediate aftermath of Raju's confession was corporate chaos on an unprecedented scale. Within hours of the letter being made public, Satyam's stock price collapsed, falling over 70% on the Bombay Stock Exchange before trading was suspended to prevent further panic. The company's market capitalization evaporated overnight, destroying over $2 billion in shareholder value and wiping out the retirement savings of thousands of individual investors who had trusted the company's reported financial performance. Trading in Satyam's American depository receipts on the Nasdaq was halted as international investors scrambled to understand the implications of the confession and assess their potential losses. The Indian government, faced with the collapse of one of the country's flagship technology companies and the potential loss of tens of thousands of jobs in the critical IT sector, took the extraordinary step of dissolving Satyam's board of directors and appointing a new government-nominated board to prevent the complete collapse of the company's operations. Major clients including the World Bank, General Motors, and Accenture immediately suspended new business with Satyam and began reviewing existing contracts, while employees around the world wondered whether they would receive their next paychecks and whether their careers had been destroyed through no fault of their own. The confession sent shockwaves through India's business community and raised serious questions about the effectiveness of corporate governance, auditing standards, and regulatory oversight that had failed to detect such a massive and systematic fraud. The investigation and legal proceedings that followed revealed the true scope of Satyam's fraud and the systematic failures that had made it possible. Ramalinga Raju was arrested within hours of his confession and charged with criminal conspiracy, breach of trust, and forgery, eventually receiving a 7-year prison sentence after a lengthy trial that captivated the Indian media and business community. His brother Raju and CFO Vadlamani Srinivas were also convicted and sentenced to prison terms for their roles in perpetuating the fraud over multiple years. The Central Bureau of Investigation's probe uncovered evidence that the fraud had been ongoing for years and involved forging documents, manipulating computer systems, and bribing bank officials to provide false confirmations to auditors. PricewaterhouseCoopers faced intense scrutiny for its role as the company's auditor, with critics questioning how such a massive fraud could have gone undetected for so long despite annual audits that repeatedly certified the accuracy of Satyam's financial statements. The scandal led to significant reforms in Indian corporate governance regulations, including stronger audit requirements, enhanced disclosure standards, and more stringent penalties for corporate fraud. Remarkably, the government-appointed board managed to stabilize Satyam's operations and eventually sold the company to Tech Mahindra in a competitive bidding process, allowing most employees to retain their jobs and ensuring continuity of service for clients who had relied on Satyam for critical business processes. The Satyam scandal became a watershed moment for Indian business, demonstrating both the vulnerabilities in the country's rapidly growing corporate sector and the resilience of its institutions in responding to crisis. Today, the company operates as Mahindra Satyam, a reminder of how even the most spectacular corporate frauds can be overcome through decisive action, regulatory reform, and the fundamental strength of legitimate business operations that continue to serve real clients with real services, even when built on a foundation of lies.